The broadcast is now starting. All attendees are in listen-only mode.
Good evening and welcome, members and guests. My name is Hanny Michael. I'm the president of the International Model Stock Investment Club. We're a better investing model club that's open to the public. Our meetings are held on the third Monday of each month at this time. I would note that we changed our starting time from 9 p.m. Eastern to 8:30, which is 5:30 Pacific, and for all those on the West Coast. All our meetings and stock studies are held online, allowing us to have members from around the world. Our current members are from the United States, Canada, and China. Guests, you're going to be muted during the meeting, but you'll have an opportunity to ask questions and give your feedback and comments once the official meeting ends. And just wanted to mention that any companies that we mentioned today are for educational purposes only, are not intended to be a recommendation for buying or selling any stocks, and we ask you to conduct your own analysis before making any investment decision. And this meeting may mention products or services not endorsed by BetterInvesting or our club, and the views of our members may not necessarily represent those of BetterInvesting. This meeting is being recorded and will be posted to our YouTube channel for future use. So with that, I just wanted to very quickly go through the agenda. So today we have a couple of I think a pretty interesting meeting coming up, because we have an education topic on Value Line, and that Tom will present. But we also are going to have an industry study on the cybersecurity industry, and there are 3 companies that we're going to be looking at that some of our members or potential new members will be presenting. And I think this is very timely because as more and more people are working online and companies are moving their businesses to the cloud and going to e-commerce, there's a real need, I think, and there'll be a lot of growth in this cybersecurity industry. And we read a lot in the press about even countries that are using cyber attacks and that sort of thing. So it's very timely, I think, and we should have a pretty interesting discussion. So with that, I'm going to pass it on to Tom for the Treasurer's report. So Tom, I'll make you a presenter.
Unmute myself here, I guess.
Sure, just give me 1 second.
Already made it.
Oh, you did it. Okay, great. Thank you, Jay.
Mm-hmm.
So this is this is our portfolio. These are the stocks that we hold. Now I'm trying to look at. Hanny, can you tell me where I can find the profit and loss on this? I can't remember where to go here.
On the portfolio, there's portfolio gain and loss on the left side the panel. The last.
Oh, there we go.
There you go. Uh-huh.
Okay, so we've guess we've done definitely better on some than others. It looks like the biggest winner here has been Lam Research, followed by Heiko. Biggest loser has been BJ's Restaurants, followed by Air Lease. So this is our gains and loss. Valuation statement. These are the stocks we hold. This is I guess we've got a lot of money in cash, 37.5% in cash, and these are the different stocks, the percentages that they represent. I did a little bit here with this selling guidelines that Manifest Investing put out a while ago, I guess 2 or 3 months. And I just thought I'd go through that quickly with our portfolio. They said we should look at quality. Quality is the aggregate of relative profitability and sales growth as comparing companies to their peers, as well as their financial strength and earnings predictability. So these are the stocks we hold, and this is the Manifest quality ranking. Except for the top 3, they all have decent quality. But the other 3, I guess BJ's, Inogen, and Innovative Properties are ranked lower for quality. And
Tom, just a question that, if you don't mind, did you speak with Manifest about IIPR? Because I don't recall that they had that on their list of stocks or
they're constantly changing things. I don't know. It's
okay.
It's here.
Okay.
It's so anyway. This is they talk about the quality may they think sometimes there's been a precipitous drop in quality 3 to 6 months before the price drop. So I looked at these 3 here. Wasn't able to make a whole lot out of this. BJ's, this is a 1-year chart, had a big price. Everything dropped in end of March, but they had a quality drop here. Looks like maybe around January. So that's the price chart there. The quality in Inogen is the quality is the blue line. Quality shot up, then it went down, which I would have trouble figuring that out unless it had to do with this. The price went way up. Inogen stock has had a wild ride, and then Innovative Properties, the quality was almost 0. Then they brought it up to I don't know, maybe like about 20 or 25 there. So that's the story on that one. Here's the returns on the stocks. 12-month return from low to high. Looks like BJ's has lost half of its value over the last year. This comparing it to the S&P 500 and the broad market. It's way behind, and so that's the story there. These over the last 12 months, the last 3 months, Inogen has, I guess, been the biggest loser. And the last 1 month, BJ's is down. They all do. They've all done, I guess, a little bit better relative to the indexes over the past 3 months than over the past, or 1 month rather than the past 3 months or a year. And this is ranked by. Wait a minute, went the wrong way here. This is ranked by par. This is the potential annual return, or I guess, potential annual return according to Manifest. They have the lowest opinion of AQN, and they're not too hot on Disney either. I guess maybe they think Lamb has reached full value, but these are the average stock in their universe is 8.6%. So that's what they think there.
I think in terms of Algonquin Power, you'll find most utilities probably are very slow growers, because in order for them to grow, they need to develop new projects, and that typically takes several years. But they do pay a steady dividend, and So it's kind of, it just balances the portfolio out. So it really depends on what our growth targets and objectives are.
I don't understand.
Okay.
I would think the green energy, I would think the utility is like Algonquin doing the green energy will have a vision or growth. So that's the thing that I don't understand why it did not really pick up.
So if you like, in order, so they basically go in 5-year chunks. They allocate capital in 5-year chunks, and if they want to say build more wind farms, they have to go through an approval process. They have to acquire land in a particular area and so on and so forth, and then they eventually build the project and it starts to generate money, or same with solar or what have you, or they could grow by acquisition. So once they've completed certain projects on their list, then their revenue is pretty steady, and then they have to go and execute the next chunk of projects. So typically utilities don't grow at a very fast rate that way.
Okay. I also have another thinking, but we don't have to make a decision right now. I was thinking for because I noticed that we have a lot of chunk, as Tom mentioned. We may think about the contribution we put into our cash every month. We say $1,000 every month when we started. So maybe we want to think about more real. Like for example, if it's a lot of clubs, in-person clubs, they each person only contribute like a $25, no more than $50. So we may want to think about the contribution for us. So that way we don't have too much cash pile there, because every month we're adding 1,000. Just a thought we may want to think about. If just be real, like we have like a 12 people, like if we each was like a $25 a month, then we won't have that much cash.
So it'd be like $300.
Yes.
Okay,
So each
well,
month
I think we should talk
yeah,
about
we talk about
offline.
that. We don't have to make a decision, but
Yeah,
just a
we
thought. That way,
probably- Yeah, we can talk about it. We probably don't have enough time during the meeting to
right?
discuss
I know.
it.
Doesn't have just some thought.
So wait, that last column, are those projections? PAR.
Yes, that's the projection, right?
Okay, all right. So a year out from now, that's how they're coming up. Okay, all right. Thank you.
That's the return they're expecting. Like the compounded return, like we would see at the bottom of the stock selection guide over the next 5 years or something like that. That's the rate of return they're expecting.
Okay.
And that's, I think that's based on analyst projections usually.
Yes.
Well, it's Mark Robertson makes an SSG, but he takes it. Yeah, he takes the analysts as estimates into account.
So the IIPR is 26.7, but I think in the previous slide it was showing, did it lose a lot? It's lost like 30% since we purchased it?
Well, yes, but ironically, when a stock goes down, unless you change your parameters, that indicates a better return, because the lower starting point,
Okay.
the better the return.
Okay.
Hey Tom, were you able to get Air Lease the limit order the price we set at club?
It never hit that.
That low.
We priced like 18 or 20, and it's always been above like 25s or something like that. So it never went down to that range. I don't know if we want to revisit that or not. I think we had a buy at 18 and a buy at 20. But I can, if you want to see.
I know you got a good deal, $8 a share for Air Lease.
Well, in the 8 or 9, somewhere there.
Wow.
But this Air Lease, this is the price chart, and I think we've let's see here, we put in that order somewhere around maybe 3 months ago, and
never gone that low.
I don't know if that's way over to the left-hand side there, but yeah, but see, we put in the order, I guess about the 18th or something like that, but it's always, it's always been this high. So I don't know if we wanted to try, put in, think of, 25 or something like that, or we just want to buy some now, or just want to forget about it, wait, see what happens.
Maybe wait till next earliest quarter or earnings report. Maybe we can decide, buy more.
Oh, okay. So I guess that's it, unless we have any more questions.
Okay, thank you, Tom.
Thank you.
Thank you. So what's next?
Next is the education topic, I think.
Okay. Well, I will begin. Now, I need to warn you here. I need this. If I have a half an hour, I need to go fast because there's a lot of slides. So
that's why Joanne is here.
Kim Butcher's value line checklist. So this is the checklist. I sent it out a few days ago, and this is a value line from February of 2018. The numbers on the value on this indicate the places where you can find the data to complete the checklist. The first item is the projection box. We want a minimum of 10% average annual return, or that would be our goal. And currently Microsoft fails that. Their value line's projecting 5 to 10%, and the average is to 7.5, so that's below that figure. We'd like to have a PE below the median PE, and they define the median PE as the average annual PE ratio over the past 10 years with certain statistical adjustments. Now, God knows what those are. It's probably a value line trade secret, but they're showing 16. We're by our methodology, the trailing PE over the past 10 years is 20.2, which is, but this current PE is definitely above those. So just to get an idea of the accuracy of value line projections, in February of 18, they were projecting a price of 90 to 110. But by May of this year, the stock price was 174, so it greatly exceeded their expectations. So they are currently projecting a price range here of 195 to 240 in the 2023 to 25 timeframe. It closed today. Oh, that's the wrong date, but that's today's price. I forgot to change the date here. Maybe it should have been 21 instead of 12, or 20. I don't know. Anyway, it closed today at 211.60, and so that gives us a relative PE of 127% compared to the 5-year average PE of 27.8. Now, Value Line adjusts their earnings on their reports, which can be kind of confusing because it's different than the GAAP earnings that the companies report. So they, like in 2015 here, for example, they reported Value Line showing 265. The company reported $1.48. The Value Line is saying that there's an extraordinary item here of $1.17. So they add that $1.17 back in, added to $1.48 equals the 265. So that's how they got to that. And so just for fun, I did a stock selection guide using the Value Line data. You can see how nice and smooth this is, and eliminates this 2015 and 2018 dips. I don't know what happened in 2015, but in 2018, they had a huge tax bill related to the Tax Act of 2017. So that explains that one. Value Line says the stock is undervalued if the price is below their solid line. This is their line here. They call this the value line. And so it's a multiple of their, it fits their stock price history and also their projected price. And they say the multiple can change. They raised the multiple from 16 to 19 between in the last couple years, which would raise the price, but it's still above their projection. Now this is Kim's idea, this quick and dirty discount cash flow. Now value line quote unquote cash flow is different from the GAAP cash flow. I'll explain that in a couple slides. But for them, it's the sum of the net income and non-cash charges. So to get to the free cash flow per Kim's method, we take that figure and subtract dividends and capital spending. We get $5.95. Multiply that by the multiple over here, which is $19. We get $113, which is well below their projected price range here over the next 3 to 5 years. So this is the official cash flow information. This is in a Morningstar format, and this shows those same items. It's got net income. They add back depreciation and amortization, subtract dividends, subtract capital expenditures. But on the official statement, there's a whole bunch of other items that the value line seems to ignore. So anyway, this is how GAAP reports free cash flow. And just to do a comparison here, by Kim's method, the cash flow in 2018 was $2.08 a share. And the way I figured it here for the same year, per GAAP, the free cash flow is $4.14. I took the free cash flow, divided it by the shares outstanding, and I got that figure. So the traditional way to do discount cash flow valuation is pretty complicated. But say the value of a company is the sum of the present values of the future cash flows. So we project cash flows in future years by estimating the company's growth rate. Say if we choose 10%, and this year's cash flow was $100, then next year it'd be 110, then 121, 133, 146, 161. Then we take those 5 years, and then add a terminal value which estimates all future cash flows. Then we discount that back to the present by what they call a discount rate, which is sort of like compound interest in reverse. And we choose this discount rate by finding the risk-free rate of return, which is usually government bonds, which is currently less than 1%, plus an appropriate risk premium to account for uncertainty. And 6% is a reasonable figure now, according to experts. So if we take this 6%, round this to 1%, we have like a 7% discount rate. So just to get an idea about this discounting, if we receive $1.07 1 year from now, that has a present value of 100, has a present value of 100, assuming a discount rate of 7%. 114.50 received in 2 years, it'd have a present value of $100. So that's, like I said, compound interest in reverse. So Matt he used a spreadsheet developed by a finance professor. He found a discount cash flow value of the stock is 209. Morningstar gives, and I'll send out his spreadsheet along with the slides after we're done here. Morningstar uses similar methodology. Their fair value is 196. The current price, like I was saying, was 211.60. So the next item is calculate revenue per share growth. I use this online calculator at this URL. And if you use that, you need to click on return rate to get this particular view. So the way this works, you put the target or the ending value is $29. Starting amount is $18.65, and I assume 4 years. 2020 to 2024, which is halfway between 23 and 25. Click on calculate, or zero contributions, click on calculate. So this gives us about 11.7% growth for revenue is what they're projecting. And then cash flow per share growth, will it double in 5 years? I use the same method to calculate the return. This gives us 11.6, which is less than the 14.87, which we would need for doubling in 5 years. But it's still good, but it's less. It won't double in 5 years. Is capital spending per share less than 30% of cash flow per share? Yes, by my calculations, it is. And there, but we need to bear in mind that capital spending varies by industry. Like I found Intel spends 66% of their cash flow on equipment because they buy a lot of expensive equipment to make their chips, where a software company would just need to buy some, computers and other office equipment, but have much lower expenses. Calculate the rate of growth of book value. That's 14.5% is Value Line's projection, which is good. But we know this is a good company. And then we check the common shares outstanding, if they're increasing or decreasing, and they are decreasing because the company's buying back shares. Net profit margin greater than 15%. We meet that criteria, but again, that can vary by industry. I looked up Walmart, there's just 3%, and they're a very successful company, but they have a low margin. And then for these other questions, I went to this website called finviz.com, typed in Microsoft, which brings us to this page here. Click on software and infrastructure, the industry. So here's the industry overview. Click on financial. That brings us the financial information for the industry. Clicked on Profit M for profit margin. And this indicates that Microsoft ranks 5th in the industry for profit margin, which is good out of 87 companies. Is return on capital greater than 15%, total capital greater than 15%? It is, according to Value Line. And I wasn't able to, and they were supposed to compare that to industry. I wasn't able to find anything called return on total capital, but I did find return on assets, return on equity, and return on investment, and they're near the top in all those categories, which it shouldn't be surprising. Do they have any pension obligations? No. They have sufficient free cash flow to cover the debt due in 5 years. We have $5.95 per share in free cash flow according to Kim's methodology. Multiply that times the number of shares, we get almost 44 billion. Debt due in 5 years is less than 20 billion, so easily met that. Current position, receivables, inventory, and current liabilities. Those I couldn't tell. Those don't seem to have a trend to me, and this is a little confusing. But all I could figure here was that this is their fiscal year runs July 1st to June 30th. So this is probably the June 30th figures in 2018 and 2019. This is the end of the year figure in 2019. So I went to the financial statements, and we can access those without starting in our SSG tool. Click on research, go into financial statements, click on Morningstar Financials. That brings us up to the balance sheet here. And these are, I highlighted the receivables and inventories. I like to look at percentages because if a company's growing like 10, 15% a year, those items will be growing, receivables and inventories, or we assume they will, but we want to make sure they're not growing faster than the company's growing. We don't want them having money they can't collect and products building up in their warehouses. But yeah, percentage-wise, there's it's pretty flat. If we look at dollar and click on dollars, click on percent to see that, click on dollars to see the dollars. Receivables are definitely going up, but it's not out of control on a percentage basis. And inventories actually looks a little bit down to me. Current liabilities, same situation here. Percentage-wise, looks like it's maybe trending down a little bit. But if you look at the total dollars, it's going up a little bit, but it's not out of control. Financial strength by Morningstar's, or pardon me, Value Line's rating here is A++. Their ratings go A++ to C, so Microsoft is the highest. They recommend B+ and above. And just as a side note here, only Microsoft and J&J or Johnson & Johnson have a AAA rating from Standard & Poor's. The US government's rated AA+, so these companies rate better than the US government currently. Earnings predictability greater than 80, they meet that. Our capital spending and dividends growing faster than the Value Line's definition of cash flow. In the 2016 to 2020 period, cash flow is growing faster, and dividends are growing a little bit faster here in the 20 to 24 time frame, but not anything outrageous. One thing interesting to me here is they're predicting a flat spending on a per share basis for capital spending, which actually means their capital spending is going down since the common shares are going down. And to understand this, you know, if a company has 10 shares and they spend $10, that's $1 per share. If the share count goes down to 9 and they still spend the same $10, they're spending $1.11 per share. So in order to have this constant dollar per share spending, the spending would need to go down to $9 for the 9 shares. And then we're supposed to review Form 14A, executive compensation. So you can find that by going to the tool again, clicking on research, filings and transcripts, and click on SEC Edgar all filings. And we need to search for DEF 14. Now, I don't know why it's called this, but that's what it is. So you type DEF 14 in this box, click on search, and that brings up the proxy statements. So you click on the documents, and then I search down through the document to find their compensation program. And we want to determine or decide if executives have incentives to create value for shareholders rather than simply enriching themselves. And this seems reasonable. I mean, they 7.4% of salary, almost 37, and then they get 37% in stock awards, which has a 4-year vesting. So they don't, you know, they don't get them all at once. And then the rest, a little over half, is in performance-based awards, depending on the individual employee performance and the company's performance. And this is the peer group of companies that they compare their the pay to. And these guys make a pile of money. The CEO made $43 million last year. So we review competition. There's different places to find this. The 10K is a good source of information for that. So we can find that through the SSG tool. Click on 10K, and that will bring us to here. So you click on documents. That'll bring you to this page here. Click on the top one here, which is 10K. And then I looked through that and found these competitors. They compete in various segments of Microsoft's business. Nobody competes all across the board. And according to the SSG Plus, the peers are Oracle, Adobe, and VMware. And so for the technical indicators, I went to bigcharts.com for this one. Type in.
Tom, sorry to interrupt. Just the last slide. So I think that's probably based on the products and services that they have. So like I was just looking at Sony, for example. I know
Video
why.
games.
Video games. I know that from my kids. So yeah, and then the others are
Will be cloud or software.
cloud. Yeah.
Or
So it'd be interesting just to see what percentage of their revenue comes from these different areas.
well, yeah, but I mean, I'm just doing the value line checklist. I
Yeah,
mean,
no, I'm just
this
like,
isn't a comprehensive
no, I'm
analysis
just,
of the company, but
I'm just making
that's
a
right.
general.
This is one thing to bear in mind. So anyway, to get this next one, we go to Microsoft. We click on Advanced Chart. This brings us to this view here. We click on this indicators so that we can open up this window. This brings our where we can find our indicators. We're looking for Bollinger Bands, and this
9
is
minutes,
okay. Well, I'll be done soon.
Okay.
So this is Bollinger Bands. This is an indicator. This is the stock price, and then you can't see it on this view here, but they do a simple moving average of the stock price, and then the Bollinger Band is 2 standard deviations above and below the simple moving average. So if the stock price breaches the top band, that indicates overbought, which might be a selling indicator. If it breaches the bottom, it might indicate a buy. So there's been several points here recently where the stock price breached both the bottom and the top. So it has indicated both buy and sell. The next one is the relative strength index. Over 70 is overbought, below 30 is oversold. This is relative strength here. We can see like there's been a couple, well, I guess about 3 points here fairly recently where the stock has hit in the range of 70, which might be a selling indicator. And then down back here, you know, like in well, I guess early March, it was down close to 30, which could be a buying indicator. And so for the next one, we need to go to the bottom of the page here. This is the same page. We go down to gallery view. And this is kind of a crazy one here. This is called point and figure chart, a point and figure chart. When you click on gallery view, there's several charts. You need to go down 2 or 3 to find this point and figure. And this chart, this type of a chart tracks the price change. It doesn't, without regard to time. So the user determines the box size either in dollars or percentage wise. Also the change for reversal, usually 3 times the box size. And this particular chart has a box size of 1% and a reversal of 3 boxes. So X indicates up by a box size, which is 1%. The red O's indicates price is going down by a box size, which is down by 1%. So if the price is rising, place an X in a new box for each 1% price increase. If the price is falling, place an O in a new box for each 1% price decrease. And you start a new row, switch symbols, and change direction only when the price reverses by 3%. So a double top is a buy signal. So here at this green mark, this is a buy signal. We're over here where this X, the price is going up, 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 and it breached. See, there's an X and there's an X. So when it breaches this this X here represents a double top. So that's a buying indicator. And this is Friday's chart. So Friday, the price was going down, or I guess the last few days, the price has been going down. So this, it hit a double bottom here on Friday. So that's a selling indicator at this point. But then today, the price was up. So you can see that's what was on Friday. So the price went up to, I guess, what did I say, 211.60, and it even went a little, I guess, a little higher. I don't know why it went to 685 there, but unless it went up, I thought they just did closes. But anyway, so we hit a buying indicator today. So this, we had a selling indicator on Friday and a buy signal on Monday. So I don't know what to think about that, but that's
I think
that's all the slides.
What I've been doing a little bit of reading on technical analysis, and so you can't take any one of these in isolation. What's really good, like you mentioned RSI and you mentioned Bollinger Bands and so on. So if all of them agree and give the same signal, then that's usually a pretty good indicator. If they conflict, then it's not clear whether it's a buy or a sell.
Right, but by our methodology, we would want to look at other strengths and weaknesses and everything else about the company rather than just the price fluctuations.
Right.
So I know we may have just a little bit of time left. I don't know if there's any questions.
We have 4 minutes for questions.
So can you just summarize what you found?
Well, I guess I knew that Microsoft was a very strong company before I did this. I just used them as an example because that's what Kim used. So I would be able to use that annotated chart. I didn't really find anything that surprised me, but it was good, going through the exercise to just see more in depth what Value Line was saying about the company's prospects.
There's a lot there.
Oh yes.
It seems like some of these technical tools are meant more for short-term investing versus our long-term 5-year range, right?
That's true. You could use those for trading, but like if you have a stock that you think it's a good company, and the price you think it's a buy, you might want to consider those. If the relative strength is low and the price is down towards the bottom of the Bollinger Band, and maybe it was starting to break out, like at this point here on the point and figure chart, those might all be indications that that's a good time to buy the stock. It just kind of confirm your opinion. You wouldn't just do it on technicals alone.
Yeah, there's also, I think it's a very interesting point because there's a number of companies that are developing disruptive technologies, and it's very difficult to value those companies using the BetterInvesting methodology. Like Tesla is a prime example, Illumina is another, Square is another. So all of these companies are changing the markets that they operate in, and will potentially grow at a much faster rate, and the market prices them differently. So, and this was a discussion I think that somebody had with Warren Buffett at one time. So the value investing applies to certain types of industries and companies, and when you get to these disruptive technologies, it doesn't always apply. So
Amazon has been a great a great investment, but they spend so much of their money on capital expenditures, I guess, that it has never fit an SSG. Because there's no profit.
Well, good job, Tom. We're right at 6:15, so we should get on to our stock study.
Okay, it's a really good presentation, Tom. Very
yes,
interesting.
excellent. Yeah.
Okay, thank you.
presentation to
Thank
the
you, Tom.
I
drive?
yeah, I know somebody
Okay.
retired from Microsoft at age 35, then joined Better Investing after that.
Okay. John, do you want to, let's see, can we
Can I make
pass?
a job presenter? Yep, I did.
Okay. All right, here we go. Joanne, could you let me know when I reach 8 minutes
Yes,
or whatever you want to do beyond that?
that's fine.
Okay, cool. So this is a cybersecurity industry study. I'll make this full screen so it's better for everyone to see. But the first sentence there is, of course, very general, but everyone can understand it, but it doesn't really add much to your understanding, I guess. But the second sentence, malware and phishing threats and growth in the adoption of Internet of Things, IoT. So if you're not sure what that means, I can go really general and say it's taking all the things in the world and connecting them to the internet is what the Internet of Things means. That's a very general, broad, doesn't add much to you as well definition, but it's like your phone, of course, your tablet, maybe your home in various aspects are connected to the internet now. Maybe something like a combine on a farm is now connected to the internet through technology within the combine and knows how to water the crops or harvest the crops or whatever to do with the crops through the internet. So that's like one example of the Internet of Things and needs to be protected by cybersecurity. Bring your own device, BYOD. That means being allowed to use one's own personally owned device rather than being required to use an officially provided device. So taking your phone into your office or taking your computer into your office, getting a bunch of viruses on it at home and then taking it into the office and infecting your workplace with those viruses is what we're trying to avoid. And then, okay. Most companies are shifting from a signature-based malware detection system to an IoT-enabled, Internet of Things enabled, machine learning signature-less system. And I was asked to research this the last time I did this presentation and practiced in it. So signature-based means what the old way is that they look for at least one byte of code pattern of the software in question with a database of signatures known malicious programs, also known as, those are known as blacklists. So they look for an example of something they've already seen in the past and have a list of. Now, signature-less uses, as it says there, machine learning to just look at the behavior of the programming and determine that there's a threat there and address the threat. So it uses more artificial intelligence and machine learning. So that's more where we're going and what we want to see with the companies we might invest in. And I'm not doing this well with this part. Okay, here we go. All right, so just a little bit about, a tiny bit about the growth potential for the industry, the sub-industry. It was valued at $104.6 billion in 2017 and projected to reach $258.99 by 2025. I got a bunch of other projections that I didn't include here, but it's pretty much around that range. They have a similar starting point and ending point for various years. There's a growing demand for cloud-based cybersecurity solutions, but then again, the industry standards, regulations, and complexities of research and development, so to speak, for a device might hamper growth for companies. And here we go with Europe. This is just an example of, just a simple example of how much it's grown, how much it's projected to grow, rather. 33.04 billion, 36.02 billion in 2018, 2019. That's the only numbers they give, but then you can just see based on the graphic that it's going to increase substantially according to their projections. Here we go with large enterprises versus small and medium enterprises. You can see that large enterprises here on this section over here, this side, account for more of the cybersecurity market, and but small and medium enterprises are going to catch up somewhat by 2025, going to be closer on a relative basis. So that's just, and then here's a good one, I think, because this tells you that internal spending by companies, by customers of cybersecurity companies is dark blue. So that's this right here. External spending by the cybersecurity companies themselves, that's what they're spending this on, is light blue. So you can see it's already bigger and projected to get even bigger. And I'm not sure how if the gap is changing. You could probably just guesstimate it based on what it looks like, but they're spending a lot. The customers are spending a lot on companies like the ones we're going to study tonight, and they're going to spend projected to spend more. And so then here's some more spending patterns of the customers. Enterprises are projected to spend 12.6 billion by 2023, up from 5.6 billion in 2018. So it's more than doubled on the raw basis. Enterprise spending, cloud security is projected to increase from 636 million to 1.63 billion. That's a 26.5% compound annual growth rate. And this is less growth rate, the spending infrastructure protection, 7.68 compound annual growth rate, but it's still, I just included that because it wasn't as strong of a figure really. Endpoint security tools. Endpoint is basically like your laptop, your computer, the endpoint where the human puts in stuff into the system. Or 24% of all IT security spending, and we'll reach 128 billion by reach 128 billion. I'm not sure when that is actually. I didn't notice that. For 2026, 77% of cybersecurity spending will be for externally managed security services. So that's I guess ties in with this past one right here. It's the same. It kind of tells you the same kind of information is there. Thanks, John. And that's pretty much all I have. So I'll take any questions I can potentially answer and or pass it back to Annie.
So I have a quick question. So cloud, when you say cloud-based, so is that separate from like your device? Because I mean, to send things to the cloud, you need your device too. So why do they? So when they say cloud-based, what do they mean exactly? Are they just only protecting what's up in the cloud?
Yeah, I think it's
while it's in the cloud.
hacking in the cloud. Yeah.
Yeah. Well,
Yeah,
I think
so-
also. Yeah. Go ahead, Annie. Yeah.
No, I was just going to say when you know, our company has a lot of its information stored externally in the cloud, and so you just want to make sure that that's not accessible if there's sensitive information. So and we've had like cases where there were some breaches. So the companies that are managing those data centers and so on would have to protect that data either themselves or through hiring other companies.
So if you have a document on your personal laptop that has a virus and you send it up to the cloud, it's not talking about that kind of protection.
Yeah, it's not. No, it's not.
Okay.
Security, like so.
Security. Okay, gotcha.
Yeah.
Okay.
Okay. I think we'll have Christopher go next with the CyberArk.
Can I see the first cut? Okay, so CyberArk, it's a global leader and pioneer of a particular type of cybersecurity called privileged access management. And what privileged access management, which I will like abbreviate as PAM, is that it manages something that's called privileged access, which means that what privileged access is that it is a type of administrative or super user access that allows for the full control of critical computer systems and applications anywhere and at any time. But like different users have different they have different privileges as like, so like if you're only like entry level, you don't get to like access some higher level type of information and stuff like that. So what privileged access management does is that it manages these different privileges, and like if it can tell that like certain things are like breached, it'll like shut down that certain like account, and then it will like notify the administrators and so on and so forth. So yeah, so that's what CyberArk does. And the way that they make money is by software licenses, which are paid upfront with one big lump sum, and they charge yearly maintenance fees to cover upgrades and support as well. And yeah, and they have a lot of different softwares that they do to support their privileged access management. And yeah, so CyberArk security, their ratios are all trending up. We can see here, its debt to capital ratio is significantly below the industry standard and has historically been low, which is a good sign. But and it's like only ratios that are lower than industry standards as PTP on sales and ROE. So yeah, so most of its ratios seem to reflect that it's higher and that it will continue to be trending up, and it reflects the inertia of the company that it's gaining with the increasing need for cybersecurity among companies. And then, so yeah, so why did I select 20% as my, well, it's 15 now, but yeah. So
Just
I chose
as an aside, where did you find your industry data?
so the industry data is from the, it's from the SSG at the, where is it again? Wait a second. It was from the, what was it?
Go to,
Was it compare peers?
yeah, compare peers.
Yeah, and then it was down here.
And
Oh,
then
okay.
click on industry
Yeah.
average. Yeah.
Yeah, it's at the bottom over here. Yeah.
Oh, okay. Great. Thank you.
Yeah. Okay. So yeah, so I selected this rate because so even the ANAs, so it's like all over the place. There's like 26 and 11%, but so 15% I thought it was pretty modest. It's not like too high, but it's not like too low as well. And I think that 15% is also a good indicator because CyberArk, they have been like growing substantially by acquiring like different types of cybersecurity like smaller companies. So this past year they acquired Adaptive, and before like a couple years before they acquired like Conjure and Vaultive as well. And right now they have over 50% of Fortune 500 companies, as well as like over 50% of global 5,300, I think. Global 200, yeah, over more than 35%, yeah. So okay, so why did I select 13.7% as the EPS growth rate? So I chose this because so if we look at the SSG, it's relatively parallel. So I thought that and I just went with the default that was 13.7 if I do quarter. Yeah. I think that's how I got it. And yeah, because it's a little bit all over the place as well. So 13.7 was pretty modest. And then for the low price, it was 80%. So let's just look at the SSG now. So the dip in 2017 was due to the company not reaching the company was not able to reach the analyst estimates, so the analyst prediction, so therefore there was a dip. But apart from that, it's relatively parallel. It has been growing every year, so I think that's a good sign. And then until this past year, it has no debt, and it acquired debt because it acquired the company that's called Adaptive this past last year. So then the debt rose up, and yeah, so everything's up, and then yeah, so 15%, it seems pretty modest if we look at a quarterly data for the sales, which is over here. It's been pretty high recently, so 15% seems pretty modest. And 13.7, why is it 9? Yeah, so if it's annual, it's 13.7, which is.
Oh, because you switched to the annual?
Yeah,
Yeah,
okay.
Okay.
That's how we calculated it, yeah. And then let's see. So in here, the valuation, I went with a 35 high PE forecast, and then which gave a price of 102.89. And then for a low price, it's just 80% of the market price on the date I did the study, which ended up being 82.3. And then it showed that it's a sell.
So do you want to update your stock price? Scroll to the top. And it was 7/120. So let's update it and go to the very top, go to data. Refresh study data. click on that last radio button, create a copy.
So
Let's see.
Yeah, because invalid because your high price is lower than the current price. That's why.
So, okay, so this is the issue that we had with a lot of these cybersecurity is that their high PEs are really high. If we take a look at Fortinet, you'll see, Fortinet. So we, even though it's 71 PE, high PE ratio, I think it was Ann Cunha said not to go over 30, but we said we would stretch it to 35, but it's, I think, and I actually asked Tom a question about this, the high PE, and I don't know, Tom, what's your take on this then when the price is actually, the forecasted high price is lower than the closing price?
Well, there's probably something wrong with your forecasted high price.
Yeah,
So
but
Tom, the question is what should you give for high PE?
It's because of the average high PE.
Well, I don't think that we should necessarily have hard and fast rules about what the high PE should be. I mean, I think we should go by what the company's stock price history has been. Now, some of these stocks, high PE of 50, high PE of 100 or something like that. That just seems outrageous, but I don't know. I sort of shy away from companies like that. But if a company, the current PE is 50 or 75, and you project a high PE of 35, it just doesn't work because it doesn't match reality. Now maybe they'll, maybe something will happen. Maybe the earnings will grow and the PE will come down, or if people have been willing to pay high PEs, and this has been a hot sector. People have been willing to pay up. So these are really hard to judge by BI methodology.
Christopher,
should we go to big chart?
Again, Tom, like to your point earlier, the normal PE ratio that the market has valued Amazon, for example, is 131, and the current Amazon PE is somewhere around, if you take the current price plus the forward price, it's like 153. So do you buy Amazon or not?
Oh, question.
I hold Amazon.
Can I ask a question?
Yeah.
Go ahead, Pierre.
Yeah, your future high PE is 35, but your projected future low PE is 40. How is that?
Right, I know. That was another gap. So let's focus on high PE first. So should we look the big chart, Tom?
We'll look at big charts for what?
For PEs. What
are
look
things?
The historical price. So like a company like this, just look at 5 years high PE. What will be the reasonable? Oh, you are saying look the historical stock price.
Yeah.
Jay, if you look at the button, press the button that says show hide price earnings chart. Yep. So I think that's a 10-year chart if they have the data. This one doesn't look like they have the data because it's a fairly new company.
Christopher, why don't you try putting 45 in there instead of 35?
Yeah, one thing about the PEs and projected PE that I always heard was that your 1 year projected PE should fall within your projected high and low PEs. So if your projected high PE is 45, your projected low PE is 35, your 1 year projected PE should fall within 45, 35. Then you have a good PE.
So,
okay.
No, I think I'm not sure about that. I think that it really depends on, what's happening with the company, market sentiment. Again, like if you look at Tesla, for example,
Yep.
you know,
Oh,
it
yeah,
doesn't fall into that.
No, because like you were saying, the disruptive technologies, these are more kind of emotional companies. They're not really, but people are not buying it based upon fundamentals. They're buying it upon emotions of what it might eventually be. So they're just pushing everything way up. And this is kind of lends into technical analysis, right? Technical analysis tells you when to buy, when to sell. The fundamentals tells you what's a good company, but it doesn't tell you what's a good price. But the fundamentals will tell you the price, when to buy it, when to sell it, because it works on emotions.
No, I understand. If you look at like Netflix, for example, in 2008, from 2008 to now, I'm not sure if you would have ever bought Netflix.
Yeah.
And yet the price was, I don't know what it was in 2008, was around $17 or something. And then today it's 400 and something, but it just doesn't, if you do an SSG on Netflix and any time during that period, it doesn't work.
Yeah, there you are. I know those are the kind of disruptive things. There are always stocks like that. You just can never guess.
I want
Okay,
to
can
go
we
back to
move
Tom
on just so we have time? We can have discussion after this, but
I want
we have two other stocks we need to go
okay.
over.
I want to ask Tom Tom was saying look the price, look the historic price. Tom, what were you looking for the historical stock price?
I don't know. I'm confused. I'm not sure. The historical PE is more what I was talking about.
Okay.
I think Jay, you just
So,
look at PE, and
Okay,
then
Jay.
the high PE, there's a column for high PE, and there's a column for low PE. So that's historical data. And based on that, we pick off the outlier, and then based on the average, we come up with the projected PE for high and low. And usually what I would do is for low PE, I would go really conservative. I will go with, if the current year is lower than average low PE, I will go with the current year low PE. But for the high, I will go with the average. So that's the way I would do it. And I think some people even take a discount of the average high PE or the average low PE. So I agree with Tom that you really look at the industry, the company in particular. You don't go with the hard and fast rule of 35 or over 35.
Yeah, because we noticed all these technology companies have a high PE.
Yeah.
So
Can we move on to Fortinet then?
Yes.
And then we can have further discussion.
Okay, is that Tom? Who is
That's
it?
Ariel.
Okay, I make Ariel the presenter. Hey, Ariel, did I make? Oh yeah, Ariel. Okay, go ahead, Ariel. You are the presenter. Are we looking at? Oh. You can just hit F5.
Oh, Ariel. Oh, hold on a second. You're muted. Go ahead, Ariel.
Okay, hi.
Hi.
Okay, so Fortinet is a stock that is a company that I studied. It's very similar to Qualys, which is the next one to be presented. It services small to mid-sized businesses and specializes in cybersecurity, software, and computer communications. It's mostly a subscription-based service. That's where they make most of their money, and through technical support. So this company has all of the markers that we're looking for: the sales climb, profits over 10 years, responsible debt history. But the really key factor between Fortinet and Qualys is the fact that they have no debt. My guesstimate is about 12.4%. Again, I've been looking around and estimates give different numbers as far as how much that they think that the company is going to grow. But it's projected to do very well during COVID. Now that people are moving away and into all kinds of different distributed working systems, it's all the more important to use this kind of service. Yeah, so the EPS growth from what I've estimated and from SSG study is 14.7%. This is, and I actually did do a comparison, so I have some background in this area, digital communications, for 15 years, mostly through nonprofits. And I was very careful to select the peers and to make sure that there was a one-to-one ratio. And this is some of this comparison here. And again, this is Qualys has a huge climb in debt. Now, I know that some other people from the study groups have said that this has due to leasing and new reporting requirements as far as how the spreadsheets are presented. But I would say, okay, well, in that case, Fortinet doesn't have this leasing expense and Qualys does. And it seems to be quite a big difference. This is a look at Fortinet in comparison to its price growth in the last, since the beginning of the year to the other peers, as well as their volume and PE averages on the bottom there. That's it.
Okay, Joanne, I might make you presenter to show the SSG. Joanne? Joanne, you're muted.
Yes, thank you.
Okay.
Okay, SSG. Okay, this is the Ariel. When I know we were doing email when I asked about the loading the ITK. Just quickly, I want to show you how you do that. You just come up to data. Let's see, is it? No, it's file.
It's on the homepage.
File, share study, and then you just click these, and then you can send it to yourself, and then you can upload it'll get sent to your email, and then you can load up the files. So anyway, I put together the SSG with your numbers.
Okay.
Okay, so this is what the SSG looks like. It's got a short history because it's I don't know, it looks like there was a stock price here, but I don't know what the, okay, sorry. I took these out. All right.
2014 as well, 2014.
Oh. Okay.
That's, okay.
And are these right? 12.4. So that's what you're.
I think I put is 14.7.
For both?
Mm-hmm. For the EPS. Oh yeah. Mm-hmm. Mm-hmm. Oh, and by the way, I forgot to mention that Fortinet actually was buy my target buy price this past week. So yeah, so
2015.
Yeah, so my target buy price was 126.64. Oh, that was my new one. I believe it was 128, and it hit that price briefly, and I was able to buy the stock. So when I last looked at this stock as opposed to Qualys, it was estimated at that time that at that price it was a little bit too expensive, but if they came down a little bit, then it would be worthwhile. And so that's actually kind of what happened. happened this past week.
Okay, and so I just wanted to show you'll notice how the high PE for Fortinet is like 1,000 here, 208, 253. It's just way off from what it kind of settled down to at for 2018, 2019. So
what happened to the company in 2015? There's a huge dip on the earnings and pre-tax profit.
I don't know. Do you know?
No, I don't know.
Okay.
Yeah, so right now it's in the hold range. So my strategy was basically to take care of, to put out a limit order in case of some stock volatility, would put it into the buy range. And that's what I was actually happened to be lucky enough to be able to do that.
So did they talk about their future growth and what's the plan? So apparently they don't have any debt. I don't know if they have any acquisition, or if they had acquisition, does that mean they just pay everything by cash?
They have never had any debt.
I know. Did they have any acquisition?
I don't know.
Like, how are they expecting to grow? Is it
Their subscriptions, their services.
So organic growth.
Mm-hmm.
So
Subscriptions and. Mm-hmm.
what size of this company? What's the size of this company?
medium?
Can I take a look at the sales price? I mean, not price, I mean sales revenue. What's the current revenue? The first page. $2 billion?
So the growth has been over 23%, but I just chose 24 just to be conservative. I mean 12.4 just to be conservative as my forecast.
I think we struck out some of these to get the most recent.
Can someone remind me again on the top right when you use annual versus quarter?
Oh, yeah.
Like what? Why do we use annual?
It's supposed to flatten out the volatility that we're experiencing right now.
Okay, for this industry, is that why you selected annual?
Well, just for
or because of COVID?
Yeah, because of the COVID. Yeah.
I see. Okay.
It's just.
Joanne, could you just show the bottom panel, please, the evaluating management?
Oh, I never did get, I'm sorry, I'm late today, but
Hi, Bernard.
I never get hi, hello, the stock studies on these. I printed out a lot of stuff, but I never did see any stock studies.
Yeah.
I don't know what I did wrong or what.
Loaded. This one wasn't loaded. Sorry about that.
Oh.
Okay. So,
okay.
Christopher, what's the ROE on your company? Do you remember? Anybody?
Check.
Okay.
Let me check here in a second. The ROE.
5-year average.
5-year average ROE.
Jay, if there's one more, right?
Yeah, Qualys.
It is 9.3%.
Okay.
Can we
so
move on to
what I did was, we'll do this at the end after Qualys, but I did a stock comparison guide.
Oh yeah. Okay. Excellent, Hanny. Can we hand this over to
Tom?
Tom
Loftus? Okay. Okay, Tom. Is he muted? Oh no, he got it.
I think I'm okay now. You hear me now?
Okay, yep.
Okay.
See my screen?
You have to accept the.
That is his screen.
Oh, that is.
I think I have.
All right. Okay.
Yeah.
So I'm going to talk about Qualys. And Qualys, their big service is vulnerability management. So what I was going to show you is just some few pages out of their recent quarterly report. So with this vulnerability management, they give this away free. It's sort of like your, your virus protection that you get. And their idea is that as the company operate, they get into trouble, and Qualys figures out, they have this vulnerability management. They figure out what has gone wrong. They get a response for them, and they keep all the assets under protection. And they're looking for small and medium companies, and they grow with the companies. And they also are spending a lot of money on research whenever they determine that they have a product that people will need in the form of apps. So they started out with about 2 apps, and at the end of this first quarter they had 19, and since then they put out another one. So this is all their, again, this sort of vulnerability management, how they're the first generation they alleviate the problem. The second generation they start to build an app so that AI or whatever can figure it out and do it automatically. And third generation, then they put it into the product for everybody. Again, some more discussions on their asset management, their vulnerability management, theft detection. But this is where they got strong organic growth from gaining market share and the revenues over the years and over the quarters. Similarly, this is showing their apps. Back in 2008 they had 2, and then 19 at the end of the first quarter. This is showing the revenue, and this line, the blue line, is their app growth. So the new apps, they're all enabled by the cloud, and then they're showing these services to their customers. And so the other thing they're showing here is that how their customers, with 73% have 2 solutions, and this is right, and that in the first quarter of 17 they had 62%. Now it's gone up to 73. Similarly, with 3 positions going from 27 to 50, then 9 to 32, and then 5 solutions from 3% up to 18. The other thing about the more apps that people get, it's, if you get a customer with 4 apps, it's 5 times the revenue you generate off a single app customer. So they also, as people get more apps, buy more apps from them, they become more sticky. And if they only have 2 apps, they're 94% potential to stay as a customer. If they have 5 apps, they're 99% likely to be a continuing customer. So this is the aggregate revenue by their customers. And then this is showing their where the revenue per person per head count. So $1 million in 2015 per head count, up to 1.2 million in 19. Expanding margins as measured by EBIT, and then the free cash flow is growing. This is showing their adjusted EBIT margin versus the security peers. And so they're showing themselves as first 44%. Here is cyber that Christopher talked about, and then Fortinet that Era talked about. So the medium is 12%. All these companies are doing better than that, but Qualys is the best. So this is another measure. Again, this is for they're looking at the growth rate and the profit margin to be over 40%. This is something that venture capitalists look for whenever they're looking at investing in software companies. And Qualys at 59% exceeds that 40%. And Simply Cyber and Fortinet are in here too, above the 40% rule. So this is, we were talking about PE, and I just thought we could talk about that just for another second, another way to look at it. And this is Qualys's PE here at the 40. This is, what we think of a PE with the S&P 500, somewhere around 17 on the 5-year average. And then the peers. So the peers in this group have a PE, the average of 69. So this is the 80 line going across here. So they were higher earlier in like 16 and 17. They're coming down a wee bit, but like we were, or some people are agreeing to that you can't expect to go in and buy one of these security companies with a PE in 17. So on the first cut, so this is Qualys ratios are all trending up, with the exception of the debt to capital, and it really isn't debt. It's just a new way of with the new security rules that you include your leasing costs with your debt. Qualys is also a little below the India average on pre-tax sales and return on equity, but these are increasing and improving as we showed you in their quarterly update. So the current PE ratio is 59.6, average is 52. How does Qualys make money? So their premier product is this vulnerability management. It takes it to the next level, providing the power to continuously detect vulnerabilities and misconfigurations across the entire global hybrid of the IT environment, and then respond in real time to remediate the assets that are vulnerable or already compromised from a single platform with built-in orchestration. So Qualys intends to strengthen their leadership and provide trusted provider of cloud services by spending a lot of money on research and development to extend, the products that they have, and keep improving them. And then when the opportunity is available, they will take over companies to bolster their capabilities. So I used 15.3 as the rate of sales, which was based on the last 2-year trend. This is below the long-term average to be conservative. So the projected rate for earnings per share. So the margins and ROE are both trending upwards significantly. The long-term SSG growth rate is 56%. The recent 3 years average is 29. So the 25 is conservative. And again, we had a hard time struggling with what to put in for PE, but I used 35 after, some discussion with everybody. Again, the PE is 59.6, and then the long term is 52.4, which gets me a low price of 67.5. So I've suggested we put it on a watch list. Qualys is using their dominance in the vulnerability management and current profitability to plow money into R&D and recruitment, develop additional cyber offering. They are offering new products free until the customers recognize the benefit, then switch to paying customers. Currently, Qualis price has moved above the buy zone. So if we look at the PDF of this, again, I projected at 15.3 and 25. Fairly conservative. So I got a low price, or sorry, a high price of 79.4, 67.5 for the low price, and so it's just outside the buy zone. The return is only 10.6%. Now I used the price, which was the Friday price of 108.49. Today the price went up $5. It's 113.50. So if you have any questions, or if you want to look at the Qualis in the SSG, I can take any questions people have.
Yeah, I just one question I have, Tom, is like if you can pull up the second screen, if you don't mind.
Yep.
The page 2. So if I look at the low PE average for the last 5 years, it's 37, and the high is 67.
Yep.
And
that's taken out a couple of years too.
Taken out a couple, and you know, you're projecting a high PE of 35,
right?
Which is lower than the average low of the last 5 years. So I'm just wondering if you're being a bit too conservative, maybe, given that, you know, they've had historically the average PE is about 50 between the, you know, the high and the low.
Right. Well, you know, Joanne wrangled us into you know, the group and try and do this. So we had lots of discussion on what we should use as a PE, and I guess we try to get a consensus. We didn't want to bring out, you know, like a PE of 100 and then go the other way, but we can put 45 in if you want to try that.
Yeah, I would.
But the problem is, Tom, you have low PE of 37, which is higher than high PE of 35.
Yeah. Agreed.
Okay.
Agreed.
Yeah, I do. I mean, I'm learning too. So yeah, I was uncertain about how to do a judgment on a PE that this was this high, but yeah, I agree. 45 would be a good.
I think 45 is still low.
Yeah, I will say try 55, because what I'm looking at is last year was 57.
Yeah.
And
right. Well, you're into the buy zone with, you know, like you've got upside down ratio of 2.6, and you're starting to show some yield. But if you put what you say 55,
okay,
that would definitely.
What's the current? Yeah, I think. Hold on. What's the current price? 108.
115.
113. 113.
113. It went up.
Actually, this even 45. This I'm happy with the high price next 5 years. Double our money, 5 years. I'm happy. Not even go on to 55. Even 45 can double our money, double my money if I invest it right now. Right? So right now you have 113. Yeah.
Yeah.
So you don't need to get, then you will be even higher. I don't need to go that high. We're just saying,
Oh,
even
agreed.
with conservative, yeah.
Yeah, I also think the selected low price is about, you know, 40% lower than the current price.
Okay.
So something really drastic would have to happen to go down by 40%. You know, Tom was showing us in our portfolio some of the companies and how much they went down in the last year. For example, I think like 30 something was the highest. So I think the forecasted low price is a little bit too low, maybe as well.
Too low. So what's the 52 weeks low price? 69. Yeah. 69. Okay. So right now 113. So
And 90 is 80% of 113.
You know, honestly, I'm okay with even go with 2019, the low price, actually.
69?
No, what Tom did was he took the average PE to calculate the 67.5.
Mm-hmm.
He did not do the 20% of a current price.
Yeah.
Yeah.
I think 67 is fine. I mean, it's just a couple dollars low, higher than the 52-week low.
Yeah. I would say too.
Okay.
Okay.
Okay, so now we have to vote.
I have a question. Why do you guys present 3 companies? Why
Because
did you
we
pick
had
3?
an extra person.
Oh, okay. Not because these company was so great and
No, no, and actually at the time we were reviewing, I mean, they've gone up a lot in the, I mean, we actually got our stock studies done relatively early. So they've gone up since, well, we did our assessments. And I don't know if it's because of the whole Twitter thing getting hacked, but yeah.
After
So,
the Twitter thing got hacked, I bought this company.
Oh, you did?
Joanne, would you?
I did.
Would you mind? Would you
With the
mind?
comparison?
Just,
Yeah.
Yeah. I'll
Oh,
show you.
yeah.
I think that they also did a comparison to room last time. So okay, Henny, there's Henny. Okay, I make Henny presenter.
So this was I didn't have the SSG for Fortinet, so I just did one, and then I think this is the comparison, the automatic comparison that the stock comparison guide does. So the green shaded area is just the picks out the best in each category.
Right, on a point.
From the numbers. You can change that, but that's what it's showing. And so there's the count here is the count of the green shaded area. So 10 for Qualsys, 4 for the other 2. So I wanted to show that because I think when we're trying to decide on some of these companies, it's good to use this tool. It gives you a pretty good, quick sort of comparison of the various metrics.
Why CyberArk is red? What does that mean if it's red?
Not sure.
I don't
Very
think
good,
because it's
Haney.
out,
Very
it needs
good.
to be updated.
Oh, you need to refresh the
It's only
price. That's
7
why.
days old.
Okay.
Okay, that's all I wanted
Thank you,
to
Hanny.
show you.
Okay.
Yep, you're welcome.
Okay, so we're ready for voting. Or
Did you want to, Joanne, did you want to take back the screen?
Do you guys want to take a look at the front net if we use the average PE, average high PE?
Sure.
What that gave us?
Yeah.
So who's presenting? Joanne, right? Joanne.
Yeah,
has
give
the
it to
tool?
me.
Okay. So for sure that Christopher's company is not
in a buy.
Is I forgot what is, yeah.
It's up there though.
So 59.53.
Because we use 35 for high PE, that's why.
Okay. Try 50, what happens? 53, okay.
We might, do we want to look at Christopher's again? Because his was.
Yeah, sure.
Okay.
Yeah, sure. Okay. Yeah, it's not going to be, yeah. It's probably a hold, is it? Okay, I covered, couldn't see. Yeah. Okay, and then low P, you are using what?
I think
you're
it's
using 20. Okay. Oh, you select the 52 weeks. Oh, you selected this something. You selected.
I just took it from Ariel's.
Oh, okay.
It might be like 80%.
Oh, okay, gotcha. Okay.
At the
All
time.
right. Yeah. Okay.
Okay.
All right. So, do you have Christopher's SSG?
No. Can
I can share. I can share my screen.
All right. I will make you presenter, Christopher.
All right. So what should we change this to?
Let's see. Let's take a look at his. What's the average high? 71.
71.
Do we just want to try? I don't know. What do you guys want to try? 65, 55?
Can you scroll the screen down, please?
That up or down?
Down, so we can see the high and low PE column.
Wait, it's up.
And do you close?
Oh, you had a
close
delay. Jin had a
close-
delay. Yeah. Yes.
Yeah, a little bit down. Yeah. I will use 71 or 70. Just use 70 for high. And use 42 for low.
Do you think the low price is too low?
Yeah, it's
Because
way.
low price now, I mean 40 is for low, that would be fine. 70 for high, 40 for low. So it's right around the average. Let's see how it goes. Yeah, it's a whole.
But
Yeah, but
don't you
that's
think
like,
the low price is too low?
it's 50% of the price.
Current price, 50% of a current price.
Yeah.
I mean, just being conservative, right? Because our low PE for current year is 42.
Oh,
And
oh,
our
you
average
use okay. You are
our
using the
average
average
40.
low PE.
Yeah,
I
low
see what you're
PE.
saying.
Yeah, but that's last 5 years.
Yeah, but I'm always being conservative because you have 32 for
I think
201.
I think what she did was she used average high PE and average low PE.
Oh, I
Just
see.
use that to
I see.
calculate that
I
to
see.
show the yeah. Okay.
Okay.
And what happens if you use the 52-week low price as opposed to the PE?
Yeah, you can do that as well.
69.5.
69.51.
Yeah, what happens if you use that?
You can do that.
You just need, you can't use 2 decimal places, but just 1.
Same.
Yeah.
It's very
Close.
close, but yeah,
Very
close.
close,
Yeah, very close.
Try 87 as the 80% of the today's price.
It's a buy.
Oh, it's a buy. Okay. All right. Thank you.
So Ariel's company is overpriced, right?
Yeah.
Is it a little bit expensive?
It's near the edge as well.
Okay, so okay.
That's why I went it, and so I'm recommending to put it on the watch list.
Mm.
But when I bought it, it was basically just for a happenstance because at the current price, it is overvalued.
Mm.
It's still a very good company.
Okay, do we want to, does anyone want to make a motion?
So Qualys is a small company, Frontier is medium, what's the name?
CyberArk.
CyberArk is small as well.
Okay, okay.
And we need
Small companies are,
small companies to balance our
but
portfolio.
small companies are more vulnerable these days. That's the sector that's most been downtrodden during the COVID crisis. Those are the ones that are most likely to get hit.
Actually, for Qualys,
Yeah, but
it
they
is
come
number
back.
1. Yeah, it's a number 1 in vulnerability management. They are rated as number 1 by Gartner.
Mm.
So the
So
fact that
I'll
they're
make
doing well means, I mean, it's
I'll
even
make
better.
I'll make a motion to buy the 2 that are within our that are in the buy zone.
Both of them? Wait, you have
Yeah.
to do one at a time.
Why do you want to? Okay, sure.
Let's just pick the best. Let's just pick the best.
But I will pick the best. You get a 10 points versus the other 2 with 4 points.
Mhm.
So I'll make a motion to buy $1,000 worth of Qualys.
I second it.
I'd like to buy more than that.
2,000.
With our
Should we buy more?
cash we have and amount of total holdings we have, I think we should buy more than that.
Right.
Doesn't make
Hanny,
a
are you
difference.
making? Are you doing?
2,000.
Are you adding the
Revise the
Hanny?
motion.
Sorry,
Danny, but
one at a time. I couldn't hear what the question was.
Who is adding the motion?
Oh, I will. Yeah,
Okay, thank you.
I will.
Okay. So do we have the motion?
I'm just typing it now.
Okay.
But was there a second?
Yeah,
Megumi seconded.
agree.
And what's the amount?
$1,000 of quality.
2,000,
this
right?
is-
2,000.
Is there someone recommended
I-
2?
I said 1,000. I made the motion. I said 1,000, but I'll put 2 if you like.
We can discuss. After the motion is
discuss.
made, we
Right.
discuss.
Yeah.
Yes, we
Okay.
can discuss. That's right. Okay, are we, okay, Joy, are we discussing right now?
Yeah.
I do agree that to add more, John is right, we have more money, more cash.
more
Uh,
total holding too, you know.
More total
Yeah.
holding, yes.
One-
We do want to
1,000
have
is-
like a 5% or more.
Okay.
Yeah.
All right. I will change my motion to 2,000.
I'll still
And
second it.
simple majority, 1 person, 1 vote. Yes, no, abstain.
Henry?
Yes,
Yeah, I cannot vote. Can you just do yes for me?
sure. Okay, so you should have gotten an email.
Yeah, I'm looking at it right now.
Well,
Everybody
you can
should.
go to my iClub and look at current motions.
Yes.
Yeah, that's what I'm doing.
Um,
Gosh.
okay,
All right,
so Jay has not voted.
I did.
Jane said yes,
I voted.
and Bernard, Mina's not here. Megumi hasn't voted. John hasn't voted. John Dennis is not
John
here.
Dennis is, yeah.
Yeah.
He's out, yes.
Tom Loftus has not voted.
So can
I
you
did
did you
vote.
send an email? I can't get
did.
to VIX
No,
right now.
just no. So just look at your email.
Okay.
They should have
Not
gotten
here
some from.
I guess, I think the motion passed because Jane voted yes, right?
Yeah.
Bernard did not,
Yeah.
but Mina's not here, yeah. We need to remove John Dennis, so Tom is voting right now. So even though Tom is not voting the majority, we had a
Yeah,
majority.
7. Jane said yes, so it's 8 out
Yeah,
of
right.
and 8 and 4. So
I'll
okay.
vote yes. I vote yes.
Thanks,
And
Bernard.
Bernard, sorry,
Okay.
Okay.
So
Bernard as well.
are there any other motions?
Yeah, I motion to purchase 1,000 CyberArk.
Okay, I will second. Let me just type that in. Buy 1,000.
Oh, I also wanted to mention about CyberArk. They don't use Edgar or whatever. They don't file in the U.S. They're a Israeli company, so you would have to look. I forget what do they use, Christopher? Like an
They're an ADR, so they
ADR.
will. Yeah,
what
they
if they
do.
file a 6 something or a 8? It's
20K? Okay, I don't remember the number.
They don't have a 10K.
20. It was 20 or 6? I can't remember. 20
Yeah,
F. 20 F.
Yeah, yeah.
20 F. They file 20 F. So Jane, what do you like about this company?
Well, I think it's a innovative company with good potential, and the price is reasonably.
Oh, so some of the top cybersecurity companies are coming out of Israel. They have Israel has more PhDs per capita than any other country in the world, and a lot of their software is state of the art.
Yeah, and
Still
also it doesn't have a debt until this recent year when they have an acquisition.
Right.
So
I do like that company has a few acquisitions actually. They are merging and become big. They actually have few, not just the last year, 2009.
Yeah, usually I don't like too much debt, but because of the fact they acquired, they have the loan to acquire, so that's the exception. Yeah.
So is this Arc Cyber as a direct competitor with a Frontier? Frontnet? Sorry, Frontnet. It's called
I
Frontnet.
think is CyberArk licenses, Christopher, or subscription?
It's licensed.
License.
So
okay.
there's a difference. A Fortinet is a subscription service, so you pay monthly, and then the licensing you pay up front, and then you pay additional if you need maintenance or any kind of support.
Did everyone vote, or I'm not seeing?
Not yet.
I haven't
I thought
seen
we were
the,
discussing. No.
Okay.
Are we ready to vote, or are we finished discussing?
Tom voted.
I have a question. If you buy the last company in 2000, why do you buy this 1000?
it's
I'm
because
actually okay
you,
with that because we have 3,000 cybersecurity now.
it seems like you like the last one better, so we thought just put 1000.
Oh, okay. Sure.
Yeah.
Okay.
Okay, I have 4 votes so far. Let me try.
Did you get
again.
mine?
Well, what size?
Yeah,
I'll say
Bernard.
yes. I'll say yes.
Okay. Megumi's
We
voted. John
always got to get
Kenderson.
out of cash.
Tom Jones, yes. And Matt hasn't voted. Jane is yes. So that's 5,
Matt voted
6.
So
I did.
voted, but what's the result?
8-4.
No, that's
No.
voted. Voted as yes or no? How do you?
Oh, how do you
Okay.
know?
So Matt, did you vote no? Matt?
Yeah, I voted no.
Okay.
I voted abstain.
Jane has voted yes, so that's 5. Bernard voted yes, so that's 6. So 6. And
No motion. Motion did
John-
not carry.
6, but John Dennis is not here.
And did
I
Tom
did not
vote?
vote yes.
Tom
I
did-
did not vote yes.
Tom didn't
Okay.
I
vote.
thought John Dennis left the club.
Yeah, left the club.
That's what
So
I'm
we
saying.
have 11 members.
Tom Loftus. Sorry.
Yeah, I can't. Yeah.
Oh, you did not give a Puro. You did not give a Puro. Did you give?
Oh,
I did not see his name. Puro. I did not see his name.
Is he here?
Yes, he's here.
It's not showing up in the members, even though
I added
he
him
was added.
today.
Oh, maybe that's why.
Okay.
Okay.
So, but regardless, let's just say
Sorry,
what we
Jay.
have right now.
Jay, sorry, just 1 second. Tom Loftus, did you vote yes or no?
Abstained.
Abstained.
Me too.
Yeah.
Yeah, okay.
And
One.
Jay abstained.
Abstain.
And
Matt, no.
and Piero,
Yeah. Yeah.
yes or no?
Oh, I would say yeah.
Okay, so that's 4 and 5, 6. So 6 yes and 5 no or abstained.
So majority?
Right?
Majority?
No, 6.
Yeah, 6 to 5. So
Okay, Mina is not here.
Yeah, Mina's not here.
Dang, we need to Mina's vote so we can break.
There's nothing to break. It's a majority already.
Is this really majority?
Yeah.
3/4. Okay.
6
2/3?
is a majority.
Just a majority.
I understand.
6 to
So
5,
11 is
11.
6 to 5. Yeah, 6 to 5.
Okay. All right.
All right. So can we
We'll adjourn.
So
Let's adjourn the
just to be
Sorry.
clear, that the motion did not pass. Is that
It
correct?
No, it
Pat.
did pass.
Tom,
So
Tom
just to-
Jones, what did you vote?
No.
okay,
Yeah,
so
Tom voted no.
Jay, the motion passed. Trust me.
Okay. Let's adjourn the meeting and let our
Okay, so
guests.
before, sorry, just
Four,
recap.
5.
for
5.
Tom. Sorry.
I've been counting only 5 people voted yes. Joanne, Jane,
Yes.
Penny,
Yes.
Bernard.
Bernard.
Okay. Megumi.
Megumi. Yep.
Yes.
Tom
Well,
Loftus.
Tom will also abstain. He voted abstain.
Abstained.
Piero.
Yeah.
Piero.
Oh, Piero, that's 6. Okay.
Okay.
All right.
So just for Tom, Tom Jones's benefit, then to recap, we're buying 2,000 of Qualys and 1,000 of cyber. Okay, so
That,
just
that isn't showing on archive motions. What's Cyber's ticker?
CYBR.
Actually, be honest with you guys, actually we have 12 members. So right now actually it's 6-5, but Mina is the one as break the right. If Vina voted as abstain or no, then there's no motion. I'm just
But he's
saying.
not
If you vote
here.
abstain, you're
Yeah, I
just
know.
He's not here, right?
I know he's not
He's
here.
not
I
here,
know.
so
Dang. No, the reason why, okay, the reason why I'm arguing with you is that why do we need to have two security companies?
They're not exactly competitors.
Yeah, they're not competitors.
Okay.
Yeah.
Okay.
There's gonna be more
Okay.
demand for them.
So could we,
Okay.
sorry, I'm gonna just cut off the conversation. Let's
Okay.
get our guests.
Yes.
Joanne, would you mind doing the honors, please?
Sure. Okay. I'm gonna stop the recording. Can I stop it? Yeah. Okay. Brian, now we're gonna have talk to our guests.
Yeah. Brian is self-muted.
Okay. Oh, hi, Brian.
Okay, there you go. Yep, excellent. The Tom's value line presentation, that was very good. The one thing that I've been trying to think how to present to my investment club, what happened here was the three companies were presented, a lot of good discussion. My contention is that those three companies, you can make a motion that you want to buy, so many shares or whatever at this meeting. Then you take the month to look at it and see if you can come up with some more questions or whatever, and then vote next meeting on what you're going to buy and determine a price that you're going to buy it at. That would give you more time to look at it, and it also give you more time to look and see how it the risk affects your portfolio and the allocation in your portfolio in the discussion to buy the portfolio and what it would do to it. And at the beginning, there was and I forget who did it, that showed the manifest investing and the portfolio.